to JPX Energy Market Weekly Updates. The supply-side news is a major factor in market volatility last week. Crude oil futures last week were trading higher as markets found support from an increased optimism on demand from China and possible Russian supply constraints. However, benchmark Dubai, Brent, and WTI market structure has come under strong downward pressure in recent weeks, indicating demand remain weak for now. On the supply side, after a week of diplomatic wrangling on the price level in Brussels, with Poland holding out for a lower price, the European Union agreed to impose a price cap on Russian seaborne oil export at $60 a barrel late on Friday, paving the way for the G7-led to launch December the 5th. It's estimated that Russia would need to redirect another 1 million barrels per day of crude oil export elsewhere as the European Union import ban kicks in. The G7 price cap will apply to Russian crude oil based on free on-board prices, which does not include the cost of insurance and shipping. The cap price level is a key factor in how Russia responds and a marker for the potential profits from circumventing the rules. Russia has made it clear it has no intention of selling its oil under the price caps, meaning it would need to develop alternative supply chains to bypass measures or shut in its displaced oil. As a matter of fact, Russia is already working on circumventing the ban on insurance by providing its own insurance to potential clients through its state-controlled Russian National Reinsurance Company. In the long term, both Russia and China might have an incentive to develop more of their own maritime insurance system in order to limit the impact of Western sanctions. The provision of alternative insurance is not the only way to circumvent a price cap. So-called shadow trade, including high-sea transshipment using dock tankers without clear ownership and records, is also likely to expand and could obstruct Russian trade analysis. According to the IEA, some 100,000 barrels per day of September loadings and 450,000 barrels per day of October loadings were missing destination information. As an embargo goes into effect, insurance and freight rates are likely to rise further to compensate for the risks associated with sanctions, which would be reflected by Russian crude oil discounts. If the tanker capacity is sufficient, Russian crude oil can find other buyers. In other words, the discounted price will not fall below the cost of Russian crude oil production. The market impact will not be significant. In practice, the price cap is imposed as fixed price rather than a differential, which will complicate compliance for traders. Traders will not know the price in advance when shipping insurance are arranged if a deal uses a variable benchmark as a standard practice. The OPEC Plus Producers Alliance said Sunday would not make any changes to output policy for now. The decision means the 2 million barrels per day cut in quotas from October levels will remain in place until the fallout from the EU sanctions on Russian crude oil imports and the G7's price cap becomes clearer. The outcome was largely expected heading to the meeting following 2 weeks of intense speculation amid various media briefings from delegates ranging from further output cuts to even an increase in quotas. The primary concern for the group remained recessionary fears and weak demand growth, which in turn is weighing heavily on prices after Dubai tumbled around $10 a barrel in November and market structure collapsed. In turn, the crunch in market structure will lead to a sharp contraction in official selling prices against the underlying benchmark, with Saudi Aramco lower prices for January loading crude on Monday. The next OPEC Plus meeting is scheduled for June 4th, though a ministerial monitoring committee co-chaired by Saudi Arabia and Russia will meet February 1st to review market conditions and potentially recommend an emergency OPEC Plus meeting. On the demand side, the latest move by China prompted the commodity market to seek answers as whether this could trigger an earlier than expected reopening of the entire economy and prompted demand revival in the world's second largest economy and Asia's biggest oil consumer. Guangzhou, the capital city of Guangdong Province, China's top GDP contributor, announced plans on November 30th to remove most movement controls and resume public transport. Moreover, Chinese authorities eased COVID testing requirements across major cities over the past weekend, as China appears to be engineering a gradual shift away from its strict COVID-0 policy. These policies were announced despite new COVID-19 cases still relatively high, according to the National Health Commission. However, it's expected the people movement would still be slow for a while before rebound, as the infected people are on sick leave, while a certain portion of the remainder stay home voluntarily to avoid infection. The rise in cases would dampen demand even if the government loosens controls. A downturn remains in the cards for the first quarter of 2023. Okay, that's all we have for this week. Welcome back next week.